some insight on news shaping the markets, the jobs data we got this morning, the reaction we're seeing. Joining us now to discuss, Jeffrey Small, the managing partner at the Retirement Income Source. Jeffrey, great to have you with us. Now, we got this jobs number this morning, came in stronger than expected at 130,000. Not a blockbuster number, but a solid number here. Does that reinforce the idea for you that the economy is resilient?
It really did. I mean, I think everybody's kind of shocked that we had that kind of a number. Even though it wasn't super stellar, it was more than double what we expected. And so what does that do for the markets? I mean, it means productivity is up, the economy is strong. GDP forecasts are, anywhere from 2.8 to 5% this year. So according to President Trump, it's 15%. So we'll have to wait and see what happens. But we are in growth mode. The economy has adopted a Trumpian methodology in its business psychology. There's lots of reinvestment, reindustrialization going on. And unemployment has ticked down for 3 months. So I think we call that a trend. But what happens with rates really remains to be seen. If job numbers keep improving month over month, unemployment keeps falling, it really de-emphasizes the need for rate cuts, which in the long term, the market won't like.
So if it has de-emphasized this need for rate cuts, you knew exactly where I was going here, Jeffrey, to talk about the Fed's course of action as we got this data. And we'll get the inflation data on Friday. Is it hard for the Fed to justify? I was just refreshing the tool, the FedWatch tool. We're down to a 94% chance of no change right now. It's good, not great. Is that enough to really hit pause?
It could be. I mean, they could justify a quarter-point rate decrease, assuming they raise their benchmark a little bit on the inflationary side. And, is inflation going to catch fire because they lower rates 25 basis points? No. Are the credit markets and the rate markets going to pay attention to that? Probably not. So the Fed needs to they need to learn again to be realigned with what's happening in the economy and not be so data dependent, but be a little have more visionary here on what's going to happen with the economy, because we've lost that element to Fed and monetary policy now.
And so if we need to be more visionary, obviously we're getting a new Fed head coming our way in the spring, assuming Kevin Warsh gets confirmed. Either way, we'll have a new head. What is your outlook for the Fed moving forward? Are we going to get that more visionary approach that you feel has been lost, or are we going to get more of the same here?
Well, I think from listening to him already, he's really setting the tone as the new Fed leader as he unseats Jerome Powell. And so, I think he's going to be more visionary, but, he has to get the rest of the board governors to fall in line with that. And if they can buy into that and he can plead his case and have data to back that up, the American consumer really needs to become more front and center for the Fed, because they're killing the consumer in terms of these high rates, in terms of mortgages, car borrowing, and credit card interest rates are just astronomical at these all-time peaks of debt maximization. And so the consumer should be more front and center from the Fed if they're going to look towards the vision going forward in the future. I think they can lower rates, long story short, without causing an inflation calamity. I'm tired of that argument. It's really getting old.
All right. So what was your take on the retail sales number that we got yesterday? I'd love to know that, if we're focusing on the consumer here, finding out that the holiday season was not as robust as we thought that it was, and also knowing we're getting the inflation number on Friday. What's your expectation there?
Well, I think, the consumer retail numbers really are more aligned with the K-shaped economy, where we have 40% of the population here doing 90% of the consumption. And as things get very, very high in price, consumers pull back. And so, but as far as inflation goes, I think we stick right where we're at. Probably that 2.1% rate on the CPI is what we'll see for the last 3 months. That's where we've been. Annualized, 2.6, 2.7 in that range. And so it would be nice to see a lower number, of course, because that would excite all of us for the possibility of, rate cuts.
And Jeffrey, I want to switch to talking more broadly about the markets too here, get your thoughts on what we're seeing here in this rotation we've had so far in 26, and a lot of signs of profit taking across the board, sending some pretty drastic moves in price action, especially on earnings, some of them almost head scratching. What are some of your takeaways from what we've seen so far this year?
Well, this is the action that we've seen with good earnings numbers coming in just signifies that market sentiment is stretched. And so, the bullish case for buying things today like Microsoft or Nvidia really rely more on longer term secular trends and, being an investor. not saying, look, I'm looking for that immediate alpha and I'm going to skyrocket here in the next 12 months. And so I think that's kind of where we are today with valuations. There are, of course, risks. We are hitting extreme levels by some strategists on suggesting that profit taking should be what we should be doing right now as the rotation occurs and the market broadens. And the market is broadening because the economy is doing well. And so that'll be good for the entire market. It'll also be good for tech as being singular and codependent in a binary environment like we've had for the last 9 years. The Mag 7 has carried the markets since 2016, responsible for 60% of the return, minus 2025.
And let's talk about 26 and this CapEx number, these astronomical numbers that are coming across the wire. We're double checking to make sure there aren't typos. Some of them were so big. Hundreds of billions of dollars here in AI CapEx from those Mag 7 names that you mentioned. Who are you seeing as the winners here?
Well, I think it's very hard from our prism to determine if they're starting to see benefits in profitability and efficiencies. And I think what's going to happen is the adoption of the AI platform and the expansion of the hyperscalers into AI is going to accelerate revenues more than people realize. And so now we have a short-term pause in between that process of seeing actual results, even though numbers are decent, high teens here for most of the Mag 7 minus Tesla. And so that trend will continue. So the street has become leery at these stratospheric valuations and saying, okay, we need to see the return on all of this investment, the 600 plus billion we're investing this year. But that doesn't happen overnight. In 2003, when everybody was complaining about Jeff Bezos investing money in Amazon, look where we are today. And so we all see the case in point.
All right, and let's talk about Tesla here. Tesla underperforming a bit year to date, down about 6%. What's your take on Tesla? And what is Tesla right now? Are they an AI company? Are they still an EV-dominated company?
Well, Tesla is like buying a stake in the electric grid of the future before the world is fully plugged in. And, most companies sell products. Tesla's building infrastructure for an entirely new ecosystem of transportation, energy storage, autonomous mobility, AI-driven robotics. And if, let's say, the 20th century was powered by oil wells and railroads, the 21st may be powered by batteries, data, and software. And really, Tesla is laying all three. So that's one you want to own.
All right, Jeffrey, thank you for being with us and for that insight there. Jeffrey Small, the managing partner at the Retirement Income Source. We appreciate you joining us on Trading 360 today.